and welcome to the Property Wealth Podcast. Today we're diving into a really exciting topic: international investing, pros and cons.
Absolutely, Sarah. It's such a fascinating area, especially for those of us looking to expand our real estate horizons.
Right? I mean, the world is so interconnected now, and there are some amazing opportunities out there, but also risks we need to be aware of.
Exactly. It's all about balancing those pros and cons and understanding what might work best for you.
So we'll explore some key benefits of international investing, like diversification and potential for higher returns. But also, we can't ignore the challenges, like navigating different laws and markets.
Yes, and we'll talk about how to do your due diligence, which is crucial when exploring properties in another country.
Totally. Plus, we'll share some real-life examples from investors who've made it work, and maybe even a few cautionary tales.
That's always helpful, right? Learning from others' experiences can really guide our own decisions.
Absolutely. So whether you're considering dipping your toes into international waters or just curious about how it all works, stick with us.
Let's get started.
Yeah, let's jump into the pros of international investing, shall we?
So, Sarah, when we think about international investing, especially for those of us over 40, it's really about understanding timing. As we approach retirement, the pressure to secure our financial future can feel quite intense.
Absolutely, Mike. I mean, it's like a ticking clock, right? People are starting to think about how to make their savings last. And with inflation being what it is, that can be a real concern.
Yes, inflation is definitely eating away at purchasing power. When you look at property in different markets, especially overseas, it can often provide a hedge against that. For instance, I know a couple who invested in a vacation rental in Portugal. They found that even with fluctuating economies, the demand for short-term rentals stayed strong, which really helped them maintain their income.
That's a great example. It's like diversifying your investments, but on a global scale. And, with market shifts happening all the time, having property in different locations can really help stabilize income streams.
Exactly. Plus, there's the aspect of wealth transfer to family. Many people over 40 start thinking about legacy and how they can set their children up for success. Owning property abroad might not only diversify their portfolio, but also provide opportunities for their kids, especially if they want to study or work in another country.
Right, and it can be a way to bond with family, too. Imagine planning family vacations to a property you own in, say, Spain or Mexico. Not only are you creating memories, but you're also building an asset that can appreciate over time.
Yes, and speaking of appreciation, markets can vary widely. Some developing countries are experiencing rapid growth, while traditional markets might be plateauing. I remember a client who invested in real estate in Southeast Asia. They were nervous at first, but after just a few years, their property value doubled.
That's impressive. And it really highlights the potential for growth in less conventional markets. But transitioning to international investing does come with its own set of challenges, doesn't it?
Definitely. Navigating different legal systems, cultural nuances, and even currency fluctuations can be daunting. One investor I worked with learned that the hard way when they didn't account for how exchange rates could affect their cash flow.
Oh wow, that's a tough lesson to learn. So it's really important to do thorough research and maybe even consult with local experts before diving in.
Absolutely. It's not just about the numbers. It's about understanding the community and the market dynamics. A well-informed investor can find opportunities that others might overlook.
And that's where the emotional side comes in too, right? People often invest in places they feel a connection to. It could be a childhood vacation spot or a dream destination. Those personal ties can make investing feel more rewarding.
Exactly. It can provide a sense of security, knowing you have a tangible asset in a place that holds meaning for you. That emotional connection can help motivate people to be more engaged in managing their investments as well.
So true. Plus, with the rise of remote work, it's becoming a lot easier for people to consider living or spending extended time in other countries.
Right. And it's not just about the money. It's about lifestyle, too. For instance, many folks over 40 are looking for a change of pace as they approach retirement. They might imagine moving somewhere with a lower cost of living or a more pleasant climate.
And that ties back to financial security. If you can invest in a property that allows you to enjoy life while also providing a steady income, that's a win-win.
Exactly, and let's not forget about the tax implications. Some countries have favorable tax laws for foreign investors, which can really enhance your overall returns.
Oh, for sure. It's like finding a hidden gem that benefits your bottom line. But it's essential to understand the local tax regulations thoroughly to avoid any surprises.
Definitely. And while it sounds overwhelming, the rewards can be significant. Plus, with more resources available online and communities of international investors sharing their experiences, it's becoming easier to navigate these waters.
Yes, and speaking of resources, I think we can transition into some core strategies for international investing, which can help people make informed decisions and set them up for success.
Perfect. Let's dive into that. So when we talk about international investing, there are definitely some core strategies and rules of thumb that can guide your decision making, right?
Absolutely. I think one of the first things people should consider is the 1% rule.
Right, the 1% rule is a great starting point. It suggests that your monthly rental income should be at least 1% of the purchase price of the property. So if you buy a property for, say, $200,000, you'd want to aim for at least $2,000 in monthly rent.
Exactly. But it's not just about hitting that number. You need to factor in the local market conditions too. For example, in some international markets, especially those that are emerging, you might find that properties can rent for a higher percentage relative to their purchase price.
Good point. And then there's the 50% rule, which is another handy guideline.
Oh, I love that one. The 50% rule suggests that you should expect to spend about 50% of your rental income on operating expenses. So, if you're bringing in $2,000 a month, you should budget around $1,000 for expenses, like maintenance, property management, and taxes.
Yeah, and that helps keep your cash flow in check. It's a simple way to assess whether the property will be worth your time and money.
And then we have the cap rate, which is a crucial metric for evaluating potential investments.
Exactly. The cap rate is calculated by taking the property's net operating income and dividing it by the purchase price. So if you're buying that same $200,000 property and it generates $20,000 a year in net income, your cap rate would be 10%.
That's a solid return. A higher cap rate generally indicates a better investment, but you also need to consider the risks involved.
Right. A higher cap rate could mean a higher risk property or a less desirable location. So it's all about balancing those numbers with the market realities.
And speaking of realities, when investing internationally, it's so important to do your homework on the local market.
Absolutely. Understanding local laws, rental markets, and economic conditions can make or break your investment. For instance, some countries have strict landlord-tenant laws that might limit your ability to evict tenants.
Yeah, and that can be a real shock to investors who aren't prepared. It's also crucial to know the economic stability of the country. Are people moving there? Is the job market strong?
Exactly, and one way to gauge that is by looking at immigration trends and job growth statistics. If you see a steady influx of people to a particular area, that can be a great indicator for future property value appreciation.
Right, and let's not forget about the importance of financing. Securing funding for international investments can be quite different from what you're used to at home.
For sure. Many international markets may require you to have a local bank account or even get a mortgage from a local lender. And sometimes you might need to put down a larger deposit.
Yeah, and that could vary widely from country to country. In some places, a 30% down payment is standard, while in others, it could be as low as 10%.
It's wise to reach out to local mortgage brokers or financial advisors to understand your options. They can also help you navigate through financing intricacies, which can be a bit overwhelming.
And what about property types? Different types of properties can have different returns and risks associated with them, right?
Definitely. Single-family homes might be easier to manage for beginners, but multifamily properties can give you better cash flow. Then there are vacation rentals or commercial properties, which also come with their own set of challenges and benefits.
Yeah, and in some international markets, short-term rentals can be quite lucrative. But you have to be careful with local regulations around short-term rentals, as they can change quickly.
Exactly. Always check if there are any restrictions on short-term leasing, especially in popular tourist destinations.
That's such a good point. And when you're evaluating deals, having a checklist can be super helpful.
For sure. Your checklist should include key factors like location analysis, property condition, potential rental income, and of course, the financing options available.
And don't forget about conducting a thorough due diligence process. This means not just looking at the numbers, but also visiting the property and meeting with local real estate professionals.
Right. And if possible, try to connect with other investors in the area. Their insights can be invaluable.
Definitely. It's all about building those relationships. Now, while we're on the topic of avoiding risks, let's transition into some common pitfalls that people might encounter when investing internationally.
Ah, yes. There are a few that stand out, and it's crucial to be aware of them to protect your investment. You know, Sarah, when it comes to international investing, one of the biggest mistakes I see people make is over-leveraging.
Yeah, that's a big one. They get so excited about a potential deal that they stretch their finances too thin, right?
Exactly. I had a client who was convinced that a certain property in a hot market was a golden opportunity. He took on a massive mortgage and, well, ended up with a property that required a lot of unexpected repairs.
Oh no. So that added financial strain must have been overwhelming for him.
It really was. He was counting on positive cash flow, but instead he found himself in a negative situation because he hadn't factored in those hidden costs.
Hidden costs? Like what, exactly?
Well, think about things like property taxes, maintenance fees, and even local legal fees for managing properties abroad. A lot of investors don't do their homework on the local laws, and that can lead to unexpected expenses.
That's a great point. I imagine not knowing the local regulations could really bite you, especially if you have to deal with bad tenants.
Absolutely. Bad tenants can be a real nightmare. I remember another investor who bought a rental property overseas without thoroughly vetting the tenants.
What happened?
They ended up with a tenant who didn't pay rent for several months. It was a tough lesson because he had already over-leveraged himself, and those missed payments made it nearly impossible for him to cover the mortgage.
Oh man, that sounds stressful. So how can someone avoid that?
Well, first off, do extensive background checks. I always recommend using a local property manager who knows the area well. They can help identify red flags that you might miss from afar.
That makes sense. And I guess it's not just about finding good tenants, but also about managing cash flow effectively, right?
Exactly. Cash flow is the lifeblood of any investment. I've seen investors ignore it, thinking, oh, the market will just keep going up. But then when the market dips,
they're in trouble, right?
Right. I had another client who invested in a property thinking she could just wait out the downturn, but she didn't account for her ongoing costs. And eventually, the property just sat empty for months.
Yikes. That must have been a huge financial hit.
It really was. She ended up having to sell at a loss, which was heartbreaking since she had such high hopes for that investment.
So how can someone really keep an eye on their cash flow in an international setting?
Well, it's crucial to build a solid budget and stick to it. And consider setting aside a reserve fund for those unexpected costs. If you're investing internationally, you need to be prepared for anything.
And timing the market, that's another common pitfall, isn't it?
Definitely. Many investors think they can time the market perfectly, but it's incredibly difficult, especially in foreign markets, where you might not have the same feel for the trends.
So what do you suggest instead?
Focus on long-term investment strategies rather than trying to predict market highs and lows. Look for properties that will generate steady cash flow over time, regardless of market fluctuations.
That sounds much more stable. But what about those hidden costs? How can investors spot those early on?
A good rule of thumb is to always ask for a full disclosure from the seller. If they're unwilling to provide that, it's a red flag.
Right. And doing local market research can help too, I imagine.
Absolutely. Look into local forums or groups, talk to other investors, and try to get a sense of the true costs involved in owning property in that area.
It seems like being proactive really pays off.
For sure. And staying connected with local professionals, like real estate agents and property managers, can provide valuable insights that could save you from costly mistakes.
So if someone has already made some of these mistakes, what can they do to recover?
Well, first, don't panic. Take a step back and assess the situation. If you're over-leveraged, consider refinancing or renegotiating your mortgage terms.
That's a smart move.
Also, don't hesitate to reach out for help. Whether it's a financial advisor or a real estate consultant, getting a fresh set of eyes on your situation can really help clarify your next steps.
And I guess learning from these experiences is crucial too.
Absolutely. Every mistake is a learning opportunity. Just be sure to take those lessons into your future investments.
So, in summary, do your homework, stay within your budget, be cautious about timing, and always be prepared for unexpected costs, right?
Exactly. And remember, investing internationally can be a rewarding experience if approached with the right mindset and preparation.
Well said. It sounds like the key is to stay informed and not rush into decisions.
Definitely. Taking the time to educate yourself can make all the difference in achieving long-term success.
Awesome. I think that wraps up this segment nicely. Shall we move on to the next steps for our listeners?
All right, Sarah, let's dive into some immediate steps our listeners can take if they're thinking about international investing.
Yeah, I think that's really important. Where do you think they should start?
Well, first off, I'd recommend doing some research on potential markets. Sites like Zillow can be a great starting point to understand property values and trends, even if you're looking outside the U.S.
Right. That's a good point. And it's not just about the numbers, is it? You want to get a feel for the area.
Exactly. And there are apps like Rentometer that can help you analyze rental prices in those markets. It's super useful for estimating potential returns.
I love that. And while they're at it, checking local MLS access can give them insights on properties that may not be listed on those bigger platforms.
Definitely. And if they want to dig deeper into the numbers, tools like the Bigger Pockets calculator or Deal Check can really help with analyzing potential deals. You can plug in all your expenses, projected rents, and really see if a property makes sense.
That's such a great way to break it down. It can feel overwhelming otherwise, right?
Absolutely. And I'd suggest starting small. Maybe analyze one deal per week. Just get into the habit of looking at properties, even if you're not ready to invest yet.
That sounds manageable. And it keeps you engaged in the process without feeling pressured to make a decision right away.
Exactly. Also, joining a local meetup group can be incredibly beneficial. You get to learn from others, experiences, and maybe even find a mentor who can guide you through international investing.
That's a fantastic idea. Networking is such a key part of this journey. And there are so many online communities now too, right?
Yes! Platforms like Bigger Pockets have forums where investors share their experiences, including international investing. It's a goldmine for information.
And reading books or listening to podcasts can also widen your perspective. Do you have any recommendations?
For sure. The ABCs of Real Estate Investing by Ken McElroy is a great read. It breaks down many concepts that apply internationally as well. And there are podcasts like Invest Like the Best that often feature guests with international investing expertise.
Those are solid options. I think it's also important to keep an eye on news related to the countries you're interested in. Economic changes, political stability, those factors can influence your investment decisions.
Absolutely. Staying informed is key. You might even want to set up Google alerts for specific countries or markets you're interested in.
That's a smart move. And I imagine, as they start to explore these international opportunities, keeping a journal or a document with their thoughts and findings could help track their progress.
Great idea. Documenting your journey not only keeps you organized, but helps clarify your thoughts as you go along.
And it can be really motivating to look back and see how much you've learned.
Exactly. Just remember, it's okay to start where you are. Don't feel like you need to have it all figured out before taking that first step.
Yeah, every little action counts. Whether it's reading one article or analyzing a property, those steps add up over time.
So with all these tools and habits, listeners can really set themselves up for success.
Absolutely. It's all about creating momentum. As they start to take action, it can lead to more opportunities down the line.
Well said, Sarah. And the beauty of investing is that there's always something new to learn.
That's so true. So with these tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
Well, Sarah, as we wrap up, it's clear that international investing can be both exciting and challenging, right?
Absolutely, Mike. We've touched on some really important points today. First off, the potential for diversification. That's huge. Investing in international markets can really spread out your risk.
Right, and then there's the opportunity for higher returns, especially in emerging markets. But, of course, we can't ignore the risks involved, like currency fluctuations and differing regulations.
Yeah, and we discussed the importance of doing thorough research. Understanding the local market dynamics is essential, isn't it?
For sure. And let's not forget the cultural differences. They can really impact investment strategies. It's all about being adaptable, I think.
Definitely. It's about being informed and prepared. And, you know, if you're over 40 and thinking about these opportunities, it's never too late to start building that wealth through real estate.
Exactly, and remember, it's a journey, not a sprint. Slow and steady wins the race, right?
Right. So, if you found value in today's discussion, we'd love for you to like this episode, subscribe to our channel, and drop a comment sharing your biggest takeaway or any questions you might have.
And if you know someone over 40 who's contemplating real estate investing, share this episode with them. Let's help each other grow.
Next time, we'll dive into a really interesting topic. Legacy planning. How to pass properties to your kids, ensuring that your hard work continues to benefit your family.
That's an important conversation, and I can't wait to explore it with you, Sarah.
Me too! Thank you all for joining us today. We appreciate you being part of our community.
Until next time, take care and happy investing.